Welcome back. Let's catch you up on a couple market stories that should be on your radar today. It's time for Rapid Fire, and here to break down the headlines are Quincy Crosby, Chief Market Strategist at Prudential Financial, Dominic Chu, and Bill Griffith. Welcome, everybody.
I'm getting rid of that lime green duster that I had in the 1970s. I thought, sure, it was a good investment, but apparently not.
You should have gone with the Bugatti, Bill.
Apparently,
yes.
Yeah.
First up, shares of Shake Shack are soaring today on the back of an earnings beat for the second quarter. And this is not alone. This is a little theme developing here in the market. It joins a bunch of other restaurants beating estimates this quarter, including Yum, Chipotle, Starbucks, and McDonald's. Consumer demand is strong. Look at those same-store sales numbers in the second quarter. Chipotle up 10%. Shake Shack was the underperformer, up 3.6%. Quincy, what is the strength in the restaurants telling you?
It's telling you you've got a consumer that has discretionary income. You've got oil prices, gasoline prices, fairly reasonable. It hasn't spiked. You have a strong labor market. And you've got most of these franchises actually offering some very nice, the 2 for $5.
Some value, yeah.
Yeah, right. Exactly. It's attractive.
Would you be buying the stocks here, given now all of the, the rallies in them that we've seen this year?
You may want to just wait, perhaps, for a pullback. But the fact of the matter is, I think that there is continued growth. Chipotle was in terrible shape last year, and the analysts have suddenly turned around and loved it. And I've noticed, actually, more lines. I don't like it. But the fact is the share price is going up. It's indicative of the bad news is out of the stock
It's
now.
one of the last places people will cut their spending is on consumables like food. I mean, they will cut their spending on other material goods before they will stop dining out.
Yeah.
Correct. People will go dine out. It's only a question of whether they go up the scale to a Capital Grill or down a scale to McDonald's and everybody else.
Or canned soup.
But the delivery thing was interesting with Shake Shack, right? Because they just inked that deal with Grubhub to do all that nationwide rollout, possibly, of their stuff. So, I mean, this is a theme developing.
We have two economies going right now, and this is very much a buyer's economy. It's good to be a consumer because you have a good job, you've got discretionary income, and low prices and low interest rates. It's a lousy time to be a producer in this economy right now for various reasons, which I know we're going to talk about.
No, it's a great point, and you're right, we will come back to that. Let's talk some Apple, though. The shares are attempting to rebound today, coming off the worst day since May. They dropped 5% Monday on fears new tariffs could hurt the bottom line, and this is worth repeating. Apple is still down 16% from its high back in October of 2018. Quincy, I mean, this is not a traditional FANG name. It's not supposed to be one of the big momentum areas of the market, but I don't want to call it dead money, but that's a pretty long time now. It's been sitting below those highs.
Well, the thing is, it's had to navigate so many obstacles. One is just to slow down, and its iPhones, those sales are down.
Right.
Then it's become the bellwether, along with Caterpillar, for example, for China. Any bad headline in China, guess who goes down? And then
is that valid? Is that a valid trade then? I mean, we all look at the Caterpillar, we look at Boeing, and we look at Apple. But is that unfair? There are other companies that should be hit by that.
There are, but the market is the market, and tell that to the algorithms, because the algorithms hit just like this. You know whom they're going to hit on the way down and on the way up. But Apple is also transitioning to the services, to the wearables. And that's a hard transition for any company to make. So the fact is,
you know what it reminds me of?
It's an investment.
It reminds me a little bit of IBM as it was making the same transition. I'm sure that's not the comparison they want to hear.
But those are in their time and age widely held stocks. Back then, IBM was widely held because it was just owned by a lot of people. These days, Apple gets an inordinate amount of exposure because of index products like ETFs. So if you sell a Vanguard 500 or buy a Vanguard 500, S&P 500 fund or ETF or a SPDR, you are by proxy selling and buying Apple. So it gets a lot more traffic and a lot more, I guess, exposure is the way you look at it. But it's also a victim of its own success because it's such a big company.
Right,
it is more widely exposed, and everything else. So it's a big story.
And think about where it sits. Is it value? Is it growth? Is it consumer discretionary?
Right.
Is it hardware? Is it service? It's in every single area. You can't go anywhere without finding Apple in your portfolio.
All right. Well, let's talk some transports. As Bill mentioned, the weakness in this economy has been more on the industrial side, and the transports are down 6% over the past week. Look at the data. Rail traffic down 26 out of 27 weeks. The transports, seen as an indicator for the broader market, Is this telling us something about the economy or not? That is the trillion-dollar question.
They've been talking about the economy for several months now.
Yes.
I mean, the transports have been down quite a bit. Look at even Berkshire Hathaway over the weekend reporting earnings. What was one of their weak spots? Their
Railroad,
transport
yeah.
division.
Northern, yeah.
Right? So, yes, they are highly sensitive to movement in the economy. They lead a lot of indicators out there, and they've been telling us that there have been problems with the production side of our economy
and
for
the
quite a long
main
time.
question is this time different? And I know I'm using that phrase
From
intentionally.
what?
From in the past, transports would often tell us that the broader economy was slowing. The business cycle was ending, so to speak. This time around, if transports and the industrial side are hit specifically by tariffs and some of the global issues you're facing.
Is it more niche or localized?
Is it more niche? Is it a bellwether?
I have
or
a
not?
theory, and I want to hear what Quincy thinks about this. You know, we've talked about the cash cushion that companies have had for so long, and I wonder if they've been willing and able to eat a lot of the higher costs that they've had to bear so that consumers don't have to.
True.
And if that's one of the reasons we have this bifurcated economy right now.
I think so, and I think you're going to see even more of this if those tariffs on those consumer goods go up. Are the companies going to eat it, or are they going to try to pass it along to the consumer?
Can't do it forever.
It could go on forever. And yes, what happens? They have to stop spending, and ultimately they may have to lay off people in order to, have a bottom line.
And that whole cycle begins then.
Exactly.
Right?
But I wanted to go over one thing in the transports because it's near and dear to my heart. It is the airlines. Because one of the things that we know is that when business spending pulls back, sometimes it's a precursor to layoffs, because if you can't get that bottom line with cutting back business spending, you'll go to the layoffs. But very often you see it in business travelers.
Do you see any sign of that yet?
No, unfortunately, no, not yet.
Unfortunately?
Because I can't get so many upgrades.
Well, that means it could be coming, too. Though, right?
Yeah, it could be coming, and we're watching for that.
We hope not. Just a final mention before we go on the currency issue. Many companies have cited the strong dollar or currency fluctuations as a headwind. How much do you expect that to be a factor now, Quincy, because of what we're experiencing this week?
It's going to continue to be a factor. Everyone talks about the president's tweets, but the fact is you want to have a weaker currency, especially in an environment where growth and demand for your exports are down. You need to be competitive, and a weaker dollar, weaker currency, regardless of where you are, helps you be competitive. There's no doubt about it. And one company after another saying a headwind. I'm amazed at some of the positive earnings reports we've had, despite the headwind.
Coca-Cola, for example, said they faced a massive currency headwind, still outperformed, which shows you that the good companies will always beat. Before we go, you had a great piece of insight we want to share with the audience. We were asking if you'd be a buyer of Bitcoin here, but your point was gold would be even higher if people weren't buying Bitcoin in this kind of market panic, currency devaluation scenario right now.
Absolutely. Gold was the safe haven. Gold has many narratives. Central banks go into gold. You can wear gold. But as a safe haven, and regardless of where the dollar is, could be strong. You get a nasty headline, geopolitical, money goes into gold. Now we're seeing it go into Bitcoin.
Exactly. So it's siphoning off. So gold at $14.85, you say, would have been higher if not for.
Absolutely.
I agree.
I think that's fascinating.
Not Ether or Ripple or anything else, just Bitcoin.
The fewer of those. Quincy, thanks very much.
Thank you.
It's been fun. Quincy Crosby, Dom Chu, Bill Griffith, thank you as always.